Welcome back to the channel. I'm Algabot, and today we're exploring an expert advisor for MetaTrader 5 called Alternation Deficit Trend. This is a trend-following strategy built on an idea borrowed from statistics, the runs test. Instead of a moving average or a classic oscillator, it measures whether recent price changes are clustering into genuine directional streaks or just flip-flopping as random noise. By the end of this video, you'll understand how it detects a trend regime, how it decides to go long or short, and how it manages every position with an automatic stop and target. Let's dig in. So what exactly does this expert advisor do? At its heart, Alternation Deficit Trend is a trend regime detector. Rather than predicting price directly, it first asks a simpler question. Is the market actually trending right now, or is it just chopping sideways? To answer that, it uses a tool from classical statistics called the Wald-Wolfowitz runs test. Here's the intuition. Take the last several completed bars and label each one with a simple plus or minus, depending on whether the close finished above or below the previous close. Now you have a string of signs. A run is any unbroken streak of the same sign. If price were behaving like a fair coin, with no memory from one bar to the next, statistics tells us roughly how many runs we should expect to see. The strategy compares the actual number of runs to that random expectation and turns the difference into a standardized score. When there are far fewer runs than random chance would produce, the signs are clustering into long same-direction streaks. That shortage of runs, the alternation deficit that gives the strategy its name, is the fingerprint of a genuine trend. When there are more runs than expected, price is flip-flopping back and forth, which signals a choppy, mean-reverting market that the strategy simply sits out. This approach can be applied to any symbol and any time frame, since it only reads closing prices and an average true range value for sizing its exits. It's designed for traders who are curious about a rules-based, statistically grounded way to separate trending conditions from noise. Remember, this is educational information only, not financial advice. And like every strategy, it can and will produce losing trades. What makes it interesting is the discipline of committing only when directional persistence is measurably present. Let's walk through the mechanics step by step. The expert advisor works on completed bars, acting once each time a new bar closes. First, it checks that enough history is available, that there isn't already an open position for its magic number, and that the current spread isn't wider than the max spread points limit, which keeps it from entering when trading costs are unusually high. Now the core test. The EA looks back over a window of bars, 24 by default, set by WindowBars. For each bar, it compares the close to the previous close and records a plus for an up move, a minus for a down move, ignoring any perfectly flat change. It counts how many up moves and down moves there are and how many runs, that is, how many unbroken streaks of the same sign, appear in the sequence. With those counts, it computes the expected number of runs under pure randomness, along with the variance, and converts the gap between actual and expected runs into a standardized score the code calls PersistZ. If the window happens to be entirely one direction, that's maximum persistence, so the code short-circuits it to a strongly negative value. The key gate comes next. The strategy only considers a trade when this Z-score sits at or below negative MinPersistZ, a default of 1.4. That condition means the run's deficit is statistically meaningful, so persistence, or memory, is genuinely present rather than a coincidence. If the score is above that threshold, the EA stands aside. Once a trend regime is confirmed, direction comes from the cumulative drift, the net change in close across the whole window. If that drift is positive, the bias is long. If negative, short. Two more filters must agree. The size of the drift has to span at least min drift ATR times the average true range, so a flat, sideways cluster is ignored. And the most recent bar sign must match the drift direction, so the EA joins an ongoing move instead of stepping in against a fresh counterswing. When everything lines up, the position opens. The stop loss is placed AtrStopMult average true ranges away from entry, 2 by default, and the take profit is set at RewardRisk times that stop distance, a default of 1.6 to 1. From there, the stop and target manage the trade to completion, and the EA waits for the next fresh bar before looking again. Let's read the actual MetaQuotes language code you'd see in MetaEditor. At the top are the inputs. WindowBars sets how many bars of signs we test, defaulting to 24. MinPersistZ is the strictness of our trend proof. The run score must be at or below its negative 1.4 by default. MinDrift requires the move to cover real ground. ATR period feeds the average true range, and AtrStopMult and RewardRisk shape the exits. Lots sets the order volume. Below the inputs is the shared gate. The line that reads, if persistZ is greater than negative MinPersistZ, return, rejects any bar where the run's deficit isn't strong enough. Then the code measures net drift across the window, checks that the latest sign agrees with that drift, and confirms the move spans enough average true ranges. It also computes the stop distance from ATR. Now the two symmetric sides. When is-long is true, meaning the drift is upward, the entry is taken at the ask price. The stop-loss sits one stop distance below entry, and the take-profit is placed reward to risk times that distance above it. The call trade.by sends the order with those levels, and the comment ADT long. The else branch is the mirror image. When the drift is downward, the entry is taken at the bid price. The stop-loss sits one stop distance above entry, and the take-profit is placed the same reward to risk multiple below. The call trade.sell sends that order with the comment ADT short. Both sides share the identical statistical gate. Only the drift direction decides whether the EA goes long or short. Now let's bring the whole idea to life on a chart. Across the top you can see the price candles, and in the panel below is the strategy's real engine, the standardized run score, which I'll call the persistence score. Watch how it moves against the trend trigger line at negative 1.4, the dashed level that marks a statistically significant alternation deficit. Look at the opening candles on the left. Price is drifting sideways, one bar up, the next bar down, then up again. This is classic chop. In the panel below, the persistence score is sitting well above zero, up in the shaded over alternation zone. Too many runs, too much flip-flopping. The signs are alternating more than random chance would predict. During this stretch, the expert advisor does nothing at all. There's no measurable trend, so it simply stands aside and protects its capital from a noisy, directionless market. Now watch the third and fourth candles. Price starts to string together higher closes. One up bar, then another, then another. As those same direction closes accumulate, notice what happens in the panel. The persistence score begins falling, dropping towards zero, and then pushing lower. The runs are becoming scarcer than randomness would allow. The market is developing memory. By the fifth candle, the score crosses below the negative 1.4 trigger line. This is the alternation deficit the strategy is built to detect. At the same moment, the cumulative drift across the window is clearly positive, and the most recent bar is an up bar, so momentum agrees with the drift. All the conditions line up, and the buy entry marker appears. Notice the EA isn't buying at the very bottom. It's joining an established uptrend mid-move, only once the persistence is statistically confirmed. The moment the position opens, two levels are set automatically. The stop-loss sits a couple of average true ranges below the entry, just under the recent structure, and the take-profit is placed at 1.6 times that risk distance above. Over the next candle's price keeps climbing, each bar carving higher, until it reaches the take-profit target and the long trade closes in the green. That's the full long sequence. Chop rejected, trend confirmed by the run's deficit, entry mid-trend, and an exit at the reward-to-risk target. Now the market shifts. After the peak, price stalls and begins to roll over. In the panel, the persistence score climbs back up above the trigger line for a couple of bars. The up run has broken, alternation briefly returns, and the EA holds off. No new signal yet. Then watch the downside develop. Price prints a lower close, then another, then another. Just like before, these clustering same direction moves starve the sequence of runs, and the persistence score dives back down. By around the 11th candle, it once again crosses below the negative 1.4 trigger. This time the cumulative drift across the window is negative, and the latest bar is a down bar, so the momentum agrees with a downward bias. The sell entry marker appears, again mid-trend, not at the very top. For this short, the levels mirror the long exactly. The stop-loss sits a couple of average true ranges above the entry, and the take-profit is placed the same 1.6 times the risk distance below. Price continues lower, bar after bar. until it reaches the downside take-profit target and the short trade closes. And that's the complete picture. The same statistical gate governs both trades. A run's deficit deep enough to prove persistence, while the direction of the drift decides long or short. The strategy deliberately ignores the choppy stretches where the score stays high and commits only when the market shows measurable directional memory. Of course, not every signal plays out this cleanly, and losses are a normal part of any approach like this. Let's wrap up. Today we explored Alternation Deficit Trend, an expert advisor for MetaTrader 5 that uses the Wald-Wolfowitz runs test to separate genuine trends from choppy noise. We saw how it turns close-to-close changes into a signed sequence, measures the shortage of runs as a persistence score, and only commits when that score confirms a statistically significant trend regime, going long or short with the drift, and managing every trade with an ATR-based stop and a reward-to-risk target. Remember, everything here is educational information only, and not financial advice, a recommendation, or a solicitation. If you found this breakdown helpful, please like the video, leave a comment with a strategy you'd like analyzed next, and subscribe for more MT5 strategy walkthroughs. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.